You're staring at a trading chart, and it feels like you're trying to read a foreign language. Words like bullish, ask, and moving average are flying around, and you're just trying to figure out if you should buy or sell. Let's be real. That confusion is a huge reason why so many beginners lose money. It's that feeling of paralysis, the fear of clicking the wrong button because you don't fully grasp the vocabulary. It's the gap between where you are now and where you want to be, confidently making decisions in the market. But what if I told you, there's a simple hack to decode this language and turn that confusion into your first real profits? What if the barrier isn't your intelligence or your strategy, but simply the language? In this video, I'm giving you the ultimate trading glossary decoder. This isn't just a list of words, it's a blueprint. By the end of this, you'll not only understand the jargon, but you'll know how to use it to your advantage, to see the market with clarity, and to finally start making informed decisions instead of just guessing. We are going to turn that confusion into cash, starting right now. Section 1, the core concepts, the market's language. Alright, let's start with the absolute fundamentals. These are the words you'll hear every single day and they basically describe the market's mood. Getting these right is your first and most critical step. First up, bull versus bear market. You've definitely heard these terms. They're just fancy words for whether the market is generally going up or generally going down. A bull market is when the market is in a strong upward trend. Prices are rising and everyone's feeling optimistic. Think of how a bull attacks. It thrusts its horns up. That's the image to keep in mind. A strong, charging market pushing prices higher. During a bull market, the economy usually looks good, and companies are making money. Investors, or bulls, feel positive and believe prices will keep rising, so they're buying. Now, on the flip side, you have a bear market. This is when the market is in a sustained downward slide. A common definition is when prices fall 20% or more from recent highs. Think of how a bear attacks. It swipes its paws downward. This symbolizes a market that's losing steam with falling prices. During a bear market, the mood is pessimistic, the economy might be slowing down, and there's a general sense of fear. Investors, or bears, think prices will keep dropping, so they are selling. Why does this even matter? Because trying to fight the overall trend is one of the fastest ways to lose money. In a bull market, buying the dip might be a great strategy. In a bear market, you have to be way more careful, which is where our next terms become incredibly powerful. Next, long versus short. This is all about how you plan to make money from the market's direction. And no, it's not just about buying. You can actually profit when prices go down. Going long is the classic move everyone knows. You buy an asset, like a stock, expecting its price to go up. Buy low, sell high. Simple. It's a bet on growth. If you buy 10 shares of Apple because you think it's headed for the moon, you have a long position. This is the most straightforward way to play the game. Going short, on the other hand, is how traders can make money in a falling market. It's a little more complex, but the idea is brilliant. You're betting that a stock's price will go down. Here's the magic. You borrow shares of a stock you don't own from your broker. Then, you immediately sell those borrowed shares at the current high price. Your goal is to wait for the stock to drop. Once it does, you buy back the same number of shares at the new, lower price and return them to your broker. The difference between the price you sold them for and the price you bought them back for is your profit. So, if you think a $100 stock is about to tank, you could short it. You'd borrow and sell a share for $100. If it drops to $80, you buy it back, return the share, and pocket a $20 profit. This is a vital tool in a bear market. While everyone else is losing money, short sellers are the ones cashing in. But, and this is a big but, it comes with serious risk. When you go long, the most you can lose is what you put in. The stock can only go to zero. When you go short, your potential loss is theoretically infinite because there's no ceiling on how high a stock price can climb. Finally, in this section, let's talk about the price itself. The spread. Bid versus ask. When you look up a stock, you'll almost always see two prices, not just one. These are the bid and the ask. The ask price is the lowest price a seller is willing to take for their stock. So, if you want to buy a stock, right now, you're paying the ask price. The bid price is the highest price a buyer is willing to pay for that stock. So if you want to sell right now, you're getting the bid price. The tiny gap between these two prices is called the spread. Think of it as a small transaction fee or a toll for trading. So if the bid is 99.98 and the ask is $100.02, the spread is 4 cents. This is how market makers, the folks who make trading possible, earn their keep. For you, a smaller or tighter spread is always better. It means the stock is heavily traded and it's cheaper to get in and out of a position. A really wide spread can be a red flag, which brings us to our next section. Section 2. The players and the playground. Who and where. Now that you know the market's lingo, let's talk about the ecosystem. Where does all this happen and who are the key players? First, the who, your broker. A broker is your gateway to the financial markets. You can't just show up at the New York Stock Exchange and start shouting orders. You need a go-between, a company licensed to execute trades for you. You open an account, deposit money, and use their website or app to place your orders. When you hit buy, they're the ones who make it happen. Choosing a good broker is a big deal, as they all have different fees, tools, and user experiences. Next, the where, the exchange. The stock exchange is the central marketplace where the trading actually happens. Think of it like a massive organized auction house or a farmer's market for company shares. Companies list on an exchange to sell pieces of their ownership, shares, to the public. The exchange itself doesn't own the stocks, it's just the venue that connects buyers and sellers in a fair and regulated way. Famous exchanges include the New York Stock Exchange, NYSE, and the NASDAQ. And while the NYSE still has a physical floor, most trading today is electronic. Lightning-fast computers match the buy and sell orders your broker sends. The price of a stock you see is determined purely by supply and demand. More buyers than sellers? The price goes up. More sellers than buyers? The price goes down. Now for two crucial terms that tell you about a stock's size and popularity. Market cap and volume and liquidity. Market capitalization, or market cap, is simply the total value of all a company's shares. You calculate it by multiplying the current stock price by the total number of shares out there. If a company has 10 million shares trading at $50 each, its market cap is $500 million. Market cap is a quick way to gauge a company's size, which usually relates to its risk. Large cap stocks, think Apple, Microsoft, are huge established companies, generally seen as more stable. Mid-cap stocks are in the middle, offering a potential mix of growth and stability. Small cap stocks are smaller companies with lots of room for growth, but they also come with higher risk. Understanding this helps you build a portfolio that matches your own risk tolerance. Finally, volume and liquidity. These two are linked at the hip and are vital for traders. Volume is the total number of shares traded in a day. You'll see it on every stock chart. High volume means a lot of people are buying and selling. Liquidity is how easily you can buy or sell a stock without messing up its price. High volume stocks are usually very liquid, and that's a great thing. It means you can jump in and out of trades easily and get a fair price. The bid-ask spread will also be tighter. Why should you care? Imagine trying to sell a rare, obscure comic book. It might take weeks to find a buyer, and you might have to slash the price. That's an illiquid asset. Now, imagine selling a dollar bill for 99 cents. You'd have a buyer instantly. That's liquid. Low-volume, illiquid stocks are a trap for new traders. If you buy one, you might get stuck, unable to find a buyer when you want to sell. Stick to liquid stocks, especially when you're starting out. Okay, you get the market's direction and the players. Now for the practical part, telling your broker what to do. This happens through order types, and using the wrong one can be a costly mistake. The most basic is the market order. A market order is a command to buy or sell a stock immediately at the best available price. It guarantees your order gets filled, but it does not guarantee the price. If you absolutely need to get into a trade right now, you use a market order. The hidden danger here is called slippage. Slippage is the difference between the price you expected and the price you actually got. In fast-moving markets, that price can change in the milliseconds between you clicking buy and your order executing. You might end up paying more than you wanted. For beginners, this can be a silent account killer. Market orders are all about speed over price. The smarter alternative is the limit order. A limit order gives you control over the price. It's an order to buy or sell a stock only at a specific price or better. A buy limit order will only execute at your limit price or lower. A sell limit order will only execute at your limit price or higher. For example, VLD is done is days. If a stock is at $100 arbin 50, but you only want to buy it if it dips to $100, you set a buy limit order at $100. Your order will just sit there, and it will only trigger if the price actually hits $100 or less. The trade-off is obvious. A market order guarantees execution but not price. A limit order guarantees price but not execution. Most experienced traders prefer limit orders to avoid slippage and ensure they get the price they want. Now, for the two most important orders for saving your skin and locking in wins: stop loss and take profit. These are your automated safety nets. A stop loss order is your most important risk management tool. It's an order to automatically sell your stock if it drops to a certain level, limiting your loss. Think of it as your eject button. Let's say you buy a stock at $50. You think it's going up, but you're only willing to lose $5 per share. You can place a stop loss order at $45. If the stock price falls to $45, your stop loss triggers and usually becomes a market order to sell your shares. This gets you out before the loss snowballs. One key thing to remember: because it typically becomes a market order, slippage can still occur in a fast-falling market, meaning you might get out a little below your stop price. Still, it's non-negotiable. It takes the emotion out of cutting your losses. On the flip side, we have the take profit order. This is an order to automatically sell your stock when it hits a certain higher price. It forces you to lock in your profits. Using our example, you bought at $50. Your analysis suggests it will hit $60. You can place a take profit order at $60. If the stock rallies to that level, your order executes, you sell your shares, and you secure that $10 profit per share. This stops you from getting greedy and watching your paper profits vanish on a sudden reversal. Many platforms let you use an OCO order. One cancels the other. This lets you place a stop loss and a take profit at the same time. If one triggers, the other is automatically canceled. It's a fantastic way to automate your trade plan. You know the language, the playground, and the buttons to push. Now, how do you decide when to buy or sell? This brings us to the two main schools of thought: technical analysis versus fundamental analysis. Fundamental analysis is about playing detective on a company's financial health. A fundamental analyst pores over revenue, earnings, debt, and the overall economy. They're trying to figure out what a company is actually worth. If they think the stock is trading for less than its true value, they see it as a good buy. This is the long-term approach favored by investors like Warren Buffett. Technical analysis, on the other hand, focuses almost entirely on the chart. Technical analysts believe that all known information is already baked into the stock's price. They study price history and patterns to predict what might happen next. This is the primary toolkit for short-term traders. While some see them as opposing views, many smart traders use fundamentals to decide what to buy and technicals to decide when to buy. Let's look at a few essential technical concepts. First, support and resistance. This is one of the most powerful and simple ideas in technical analysis. Support is a price level where a stock has trouble falling further. Think of it as a floor where buyers tend to step in and push the price back up. Resistance is the opposite, a price ceiling that a stock struggles to break through. When the price hits a resistance level, sellers often take profits, pushing the price back down. Traders spot these levels by looking at past price action. A stock repeatedly bouncing off a certain price point creates a support level. Repeatedly failing to break above a price creates resistance. A cool thing happens when these levels break. A broken resistance level can become the new support floor, and a broken support can become the new resistance ceiling. Next, a super common indicator, the moving average, MA. A moving average smooths out the chaotic day-to-day price swings to show you the underlying trend more clearly. A 50-day moving average, for example, is just the average closing price of a stock over the last 50 days, plotted as a line on the chart. In general, if the price is trading above its moving average, the trend is considered up. If it's below, the trend is down. Traders use these lines as dynamic support and resistance. A price might fall to a moving average and bounce right off it. They also watch for crossovers. For example, when a shorter-term moving average, like a 50-day, crosses above a longer-term one, like a 200-day, it's often seen as a strong buy signal. The reverse is a sell signal. Finally, you need to understand the chart itself. Candlestick charts. Those little red and green bars you see on a chart are called candlesticks. Each candle tells a story about a specific time period, like 1 day or 1 hour, by showing you 4 key things: the opening price, the closing price, the high price, the low price. The thick part is the body. It shows the range between the open and close. If the candle is green, the close was higher than the open, a bullish period. If it's red, the close was lower than the open, a bearish period. The thin lines sticking out of the wicks, showing the highest and lowest prices reached. Candlesticks are a visual language. Learning to read the patterns they form is a skill in itself, but just knowing what each candle represents is a huge leap forward. And that's it. We've just decoded the core language of trading. You've gone from being baffled by the jargon to understanding the key terms that professionals use every single day. Think about it. You now know the difference between a bull and a bear market, and how to play both by going long or short. You understand the hidden cost of the spread. You know your broker is your gateway to the exchange, and why market cap and liquidity are so vital for managing risk. Most importantly, you have the practical tools. You know when to use a market order for speed versus a limit order for price control. You understand the absolute necessity of a stop loss to protect your money and a take profit to lock in your gains. You've even scratched the surface of strategy, knowing the difference between technical and fundamental analysis and what things like support, resistance, and moving averages are telling you. This is the decoder. This was the hack. It wasn't some complex formula or secret algorithm. The hack was simply learning the language. Now, when you look at a chart and hear those terms, they won't be a source of fear. They will be signals you can use to build a real strategy and make informed decisions. If this video helped you feel more confident than you did 10 minutes ago, do me a favor and hit that like button. It tells me this content is valuable and that I should make more just like it. And be sure to subscribe and hit the bell so you don't miss the next step in your trading journey. Because now that you have the vocabulary, the next step is learning how to avoid the most common beginner mistakes. Knowing the words is one thing, but putting it all into practice without falling into the classic traps is the real key. So, click to watch this video right here to learn the 5 mistakes that cost new traders the most money. I'll see you there.